This is the Savvy Investor radio show and podcast with Mike Kinnett and Ryan Herbert of ProStatus Financial, now celebrating 20 years helping families build successful retirements and lasting family legacies. Mike is a financial planner and estate planning attorney with a master's degree in tax and 4-time Amazon best-selling author. Ryan is a 5-star Wealth Management Award winner and top-ranked financial advisor by Forbes. Now, the Savvy Investor radio show and podcast.
How does that conversation go when you tell someone, hey, when you get to 70, whatever the age is today, because it changes all the time, you have to take required minimum distributions. You don't have a say-so in it. You have to take this money out whether you like it or not. That's gotta upset a lot of people.
Well, it's kind of insult to injury, right? I mean, you've been paying fees for all these years. I mean, a lot of us for decades, we've been paying fees. We've watched it go up and down over the generations, right? Because basically every 7 to 10 years, the market takes a dump of, 30, 40%. So we wrote it up, we wrote it down, we wrote it up, we wrote it down. And we never get a break from the cost associated with it. And we never get away from the tax that we know we're going to owe on these 401k contributions, on these TSP contributions. And so I just met with some people out of Novi, Michigan, right? So they had downloaded some podcasts and called us and talked to us about some tax planning things. And it was interesting because their advisor that they were working with, and I'm not going to name the big box store, but you see the little bull running around all the time. And the advisor there had talked to them about doing Roth conversions because he thought it was a good idea. I think he probably listened to part of our podcast, but not the whole part of it. And so he sent them to some CPA that he refers people to. And the CPA said, yes, this is how you convert. And, if you pay for the Roth out of the conversion, it takes, 14, 16 years to break even. But if you have outside dollars to pay for the Roth, if you pay for it outside of the Roth conversion itself, it takes 10, 12 years to break even. So he kind of had that conversation with them. And they were 70 years old. But what was missing in the conversation, at least from my perspective, when we sat down and talked with them, Melinda said, we don't have kids, so we don't really have a legacy. Bill says he's given, most of the money to charity, his portion of the money. He has a couple of siblings he's going to give a little bit of money to, but most of it's going to charity. And Melinda's, all hers money's going to charity once the two of them have passed. And so we're sitting down, and they had a fairly large nest egg. They had done a good job. They had been good stewards with their money. And they had about $4.5 million. But for them, because frugal sounds like it's a negative connotation, has negative connotations, so it sounds bad, but they were smart. They were frugal with their money. They did not live beyond their means. They shopped for the right things. They didn't always have to buy the newest, greatest thing. So they had amassed a nice little nest egg for themselves. And it was more than they were ever going to spend. It was more than they were ever going to need. And we knew there would be large amounts of money left over. But this advisor had sat down with them and said, yes, you should do Roth conversions, sent them to a CPA that said, yes, you should do Roth conversions. And they had them converting basically $4.5 million over about 7-8 years. They thought that was the right amount of time to get it converted. And I sat down with them. And when I actually listened to them and discovered that their Social Security, their Social Security was almost what they needed. They had a very, very small pension, and they really needed about $10,000 or $15,000 a year from their investment. So if you think about it, Uncle Sam wants you to take out, roughly 4 to 5%, and the number gets bigger every year. That's what they want. They want you to take 4 or 5% of your required minimum distributions. They want you to take 4 or 5% of your account out every single year so they can get their tax dollars. Well, I actually listened to Melinda and Bill and talked about what they were going to end up doing with the money. And I threw out this idea of doing a charitable remainder trust, but I really didn't like it. But I wanted them to know that we could think outside the box. But really what I said was, why would you convert if all your money is going to go to charity anyways? Why convert this much money? You've already converted about $1 million. That $1 million will produce about $40,000 a year for you tax-free on average. So why do we need to convert the other, it was basically $2 million left over that they needed to convert. Why would we convert that at all? Why wouldn't we just give it to charity every year? And the look on their face was like, well, what happens if we need it? I said, well, you do have a choice, right? Every year we can choose to give the money to charity, or every year we can choose to pay tax on that distribution. But if you take that distribution, what ends up happening, it causes your Social Security to be taxable. And if your Social Security becomes taxable, then it causes your capital gains to be taxable. And all of a sudden you're losing 30% of everything. to taxes because you chose to take that money. Now, I don't want to take that away from you because you still have $1 million over here and you still have $1 million in your non-qualified money in your brokerage account. So you still have plenty of money left over. And I'm not saying you can't spend it, but is it a wise decision to pay basically, $500,000, $600,000 in taxes today if the money's just going to go to charity eventually anyways? And the look on their face that somebody actually took the time to think it through, and the fact that they had gone to a CPA, and the CPA, it didn't even occur to them to do QCs. The financial advisor, he told them, he at least had the wherewithal and thought to say, hey, you need to go talk to somebody about tax planning. But the fact that neither one of them thought about the fact that, hey, we don't have beneficiaries. We don't have kids or family members we need to leave this money to. Why would we pay for conversions in the first place? And if you're not having these type of intelligent, in-depth conversations, if the conversations you're having with your current advisor, or quite frankly, if you're doing it yourself, or the conversations you're having with yourself is, I spent 8 hours on the computer yesterday Googling ideas. If that's where you find yourself, if you're not able to have a constructive, intelligent conversation on true tax planning. I'm not talking about just, hey, let's convert to Roths because it's a popular thing to do and Ed Slott says everybody should do Roth IRAs. I'm talking about actually constructive, well thought out tax plans that accomplish your goals today, tomorrow, next week, next year, 10 years, 20 years, 30 years, for the entire lifespan of you, your spouse, your significant other, or your family, right? We want to make sure we're as tax efficient as possible for all these generations. Yes, we're going to talk to you about income. And yes, RMDs are part of that income play. But the fact is you get to choose how tax efficient you want to be during retirement. And that's a mistake people make. They think they have no choices, or they think that, I'm 85 and I don't have to pay taxes anymore. But the fact is you get to opt in to how you pay your taxes, and you get to opt out on paying taxes. And I'm not saying commit tax fraud. I'm saying the federal government, the IRS, the courts have told you can arrange your affairs in such a manner to pay the least amount of taxes legally possible. And believe it or not, the 0% tax bracket is a legal tax bracket to be in. You should be striving to be in the 0% tax bracket, just like we're able to create for Melinda and Bill. Go to our website, thesavvyinvestorradio.com. Go to the Savvy Investor website and check it out. We have a little button there that says tax planning, do tax analysis. It's that easy. Click on that button, set up 15-minute time. We'll talk about what you look like, what's going on with you. And if we can help you, we'll set up an appointment to come into the office and get you started on actually achieving that 0% tax bracket.
I love hearing you say 0% tax bracket.
Isn't that a nice number? I love that number.
If that is possible for whoever that you work with, that's got to be just an amazing thing to hear. Do you guys have a bell or anything like that you ring at Pro Status?
Yeah, that's right.
That's
ding,
the case?
Ding, ding, ding. It's like when you buy a Harley, right? So I don't know if you know this, but when you go into a Harley dealership and you buy a new bike, or even a used bike for that matter, they always have a big gong or a big bell. And when you buy the bike, you get to go over and ring the bell. And because it's a pretty important day in your life. I mean, maybe not as important as getting married, although maybe some of us think so, but certainly not as important as the day your kids were born. But other than those two things, it's like one of the bigger days of your life.
Kids being born, 0% tax day. That's that would be my order, maybe. I don't know.
I think kids being born are probably more important than 0% tax bracket.
Yeah.
But you know what? Now that the kids are born, they definitely want you to be in that 0% tax bracket, because the honest guy's truth, if you think about this from this perspective, most people, especially our clients, when they come to us, it turns out that they're going to have a lot of money left over. And even though we didn't save the money with the idea of leaving a bunch of it behind, the reality is that if you've been able to save the money that you have, and if you have that nest egg, it was because you made smart money choices. And as you go through retirement, you're going to continue to make smart money choices. You're not going to all of a sudden start buying $1 million houses and $10 million planes and $300,000 or $500,000 cars. That's just not going to happen if that's not what you're already doing. So the kids are going to inherit money, because remember, when we pass away, all these IRAs and retirement accounts, they go to our kids. And this is where I said earlier that, they've changed the rules on these IRAs and Roths several times and not in our favor. So in the old days, I could leave money to my wife. And when she passed away, if she was a good steward, she'd leave money to my kids. They would take money out over their lifetime. And if they were good stewards, tax-free because it was in a Roth. And if they were good stewards, it would go to my grandkids and so on and so forth. Well, the IRS, and when I say IRS, it's really Congress, the idiots that do this to us. But the IRS now requires you to take out all your money within 10 years. So my kids, when they inherit money, they have to take all that money out within 10 years. So the money coming out of IRAs and 401ks, most kids are going to inherit the money during their peak earning years between 55 and 65. So they're going to be at the highest tax brackets. IRS likes to collect taxes. So they designed this perfectly to have the money coming out to you during your peak earning year. So that's one aspect of it. And even the money coming out of the Roth, even though that money's tax-free, your kids who are now in the position of saving themselves, they're not going to take all that money out and go spend it on a Tuesday. If my two boys inherit, $100,000 or $500,000 or $1 million, they're not spending all that money on a Tuesday. What they're going to do is they're going to save it, and they're going to be forced to put it in an account that's going to create a tax bill every year because Uncle Sam wants your money. Well, stop. Get off. What's that? The gerbil wheel. Get off that merry-go-round. Stop volunteering to pay Uncle Sam your hard-earned money. They don't deserve it. You deserve it. Spend it. If you don't spend it, your kids deserve it. Charity deserves it. Pretty much, in my eye, everybody deserves your money. Except for Uncle Sam, and if you're in a state, Michigan for Bill, he's got Aunt Gretchen, so depending on what state you're on, if you have state taxes, but at the end of the day, stop. It makes, what's that? Who's that woman? Susan?
Stop the insanity.
Stop the insanity. Well, stop this insanity. Taxes, believe it or not, taxes are optional, right? Again, if you arrange your affairs in such a manner to pay the least amount of taxes possible, you could arrange them to pay 0% taxes. That means zero taxes. We don't care if they change the rules on the Roth. We don't care if tax rates go back up again. We don't care about any of that because we've arranged our affairs to always be in the lowest tax bracket possible. Sit down with Ryan, myself, and our team. We will create an income stream that you'll never outlive. We're going to show you how much you're paying in fees, how much risk you're taking. We're going to talk about long-term care. We're going to make sure your estate plan is in place. And folks, we are going to do our very best to make sure you're always in the lowest tax bracket possible so that you're always paying the least amount of taxes legally required.
Legally. I'm fired up.
There we go.
I'm fired up. TheSavvyInvestorRadio.com. Again, that's TheSavvyInvestorRadio.com. Front page, tax analysis button. Click on that, and that'll get you started with a 15-minute quick phone conversation to get the talks started for that tax and retirement plan from Mike Kinnett, from Ryan Herbert, from Lawrence Kiley, from Catherine Gross, from the entire team at ProStatus, ready to help you to and through retirement. Got to wrap things up for today. As always, we appreciate your time and everything you do to help us be as tax efficient as legally possible. But as always, you get the final word.
This is Mike Kinnett. Thanks for listening to the Savvy Investor Radio. Thanks for tuning in to the Savvy Investor Podcast and checking us out on YouTube. We'll see you, the Savvy Investor, next week.
Advisory services offered through ProStatus Financial Advisors Group, a registered investment advisor. Insurance licensed in Maryland. ProStatus Financial Advisors Group, LLC is not licensed in all 50 states. To find out if ProStatus Financial Advisors Group is licensed in your state, please call 410-863-1040. ProStatus Group, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through representatives of ProStatus Financial Advisors Group.